Good evening, students. Welcome to the session. Have you solved the question that I had given to you? We are going to start with that question first. Yes. Have you solved that question? I had given to you one question on charitable trust and then you had many days to solve that. So let's get quickly started with that particular question. Let me just share the screen once again for that question. Okay. So a public charitable trust, which is registered under 12AB, runs a hospital and also a medical college. It furnishes you the following information for the year ended 31st March 2023. It should be 24 for this year. Gross receipts from the hospital, rupees 425 lakh, including the voluntary contribution towards the corpus. So what will happen to this 425 lakh? Yes, good evening, Mansha. Good evening, Shankara. Good evening, Viraj. Good evening, Sailesh. Yes, what will happen to this 425 lakh? Good evening, Namrata. Yes, students, what will happen to this 425 lakhs? We'll start with the question first. Let me write a solution over here. Yes, students, faster. Statement of total income, particulars, amount in rupees. Yes. So I have the gross receipt from hospital 425. Yes, Mansha, you are correct. We will take 425 minus 32 lakh, which is the voluntary contribution. Okay. So which includes the corpus and the anonymous donation, everything. Okay. So yes, you're correct. 393 lakhs is what we will take it over here, Mansha. So gross receipts 392 lakh. Okay. Then the next point says that income from business incidental to main objects rupees 2 lakh. What will happen to this? Yes. What will happen to this? Income from business which is incidental to the main object. 2 lakh rupees. Students, faster. I had expected you to solve this question. Included because they are not maintaining separate books of accounts, Mansha. So, because they are not maintaining separate books of accounts, no, that is not the reason, Mansha. Do we have to take the 20% over here? Do we need to consider whether it exceeds 20% of the total receipts? Yes. Do we have to see that criteria? Yes, students. Students, please reply. This is going to be a very important question. This was asked in my attempt, okay, and it was confusing to me as well that point of time. So it's very important. This could come this year in examination as well, these kind of questions for the charitable trust, because every year the charitable trust has so many amendments. Yes, please, students, be fast. I'm not getting any answer. If you don't reply, you will be making mistakes in the examination. So I expect you to reply, and we have to finish off this chapter and start a new chapter so we don't have any other time. If it is incidental to business, need not comply any other condition. No, Mansha, that's not a correct answer. So only Mansha is giving me the answer. Nobody else has revised it or is present in the lecture. Yes, Namrata, what do you think? We have to include it, exclude it. What will be the effect? What will be the reason? Yes. Okay. So students, what did I tell you? Only in the case of if the object is the advancement of any other object of general public utility, only then you see the criteria of 20%, isn't it? So what did I tell you? Even in the last class when we were discussing, remember we had the discussion around this particular point. If you remember when we started with the charitable trust, the meaning of the charitable trust as defined under section 215, what does it say? It says that if the object is advancement of any other object of general public utility, then it shall which will not include carrying out of any activity in the nature of trade, commerce, or business. Exception is if the activities are undertaken in the course of advancement of object of general public utility and the receipts from the activity are less than 20% of total receipt. Now, this particular point is applicable only in case of advancement of any other object of general public utility. This is not applicable for any of the other objectives. Now, if you look at the question given over here, the question says this is a charitable trust running a hospital and a medical college. So this will fall under the medical relief. So this exception will not be applicable on this particular point of medical relief or any kind of the other objective. Are you getting this point, student? So if you look at it, this particular 20% condition, the exception which is available is only for the advancement of any other objective of the general public utility. It is not applicable on rest of the charitable purposes. Since here the object is medical relief, so 20% criteria will not be applicable. This is how you have to write in the examination. So business income, since it is incidental to the main objective, this will also be eligible for section 11 exemption, but we will include it because we have to compute the exemption based on the application and 15% criteria. Here you can write down 20% criteria or the exception of 20% is not applicable as the trust is having object of medical relief and not of general public utility. It is assumed in case of incidental business income, it is assumed that separate books of accounts are maintained. You will assume, since the question doesn't specify anything, you will assume that the separate books of accounts are maintained. Mansha, we are assuming that they are maintaining the separate books of account. Okay. Next is voluntary contributions received from the public, rupees 32 lakh. It includes the contribution of corpus donation of 3 lakh and anonymous donation of rupees 5 lakh. Now you have excluded the anonymous donation and the voluntary contribution, everything else. But the question now remains is what will happen to the voluntary contributions over here? So now whether we need to include it, whether we need to exclude it, what we need to do. Yes, students. So voluntary contribution, whether it will be 32 lakhs, whether it will be 29 lakh, or whether it will be 24 lakhs. What will be your voluntary contribution that you will take into consideration? 32, 3, and you will reduce 3 and 5, or you will only reduce 3, or you will take the entire 32. Yes, Mansha, voluntary contribution will be 24 lakh. Yes, correct. Salish, you will include entire 32? The answer is no. You will consider 24 lakh. Yes, Salish, you're correct. We will consider 24 lakh over here. So, voluntary contribution 32 minus 3 minus 5. This is 24 lakh. Here also you can write down 425 minus 32. Okay. So this is 24 lakh. Now what about the anonymous donation? What about the anonymous donation and the corpus donation? What will happen to that? So the corpus donation will not form part of the charitable income. So if you remember, we had discussed that the corpus donations which are given, these are not considered as these are not considered in the total income. So the donation towards the corpus of the trust is not considered as the income. It is exempt in nature. Okay. It is exempt in nature. Fine. Now, what will happen to the anonymous donation? What will happen to the anonymous donation? Yes. What will happen to the anonymous donation? You can just first write over here. Corpus donation are excluded as it is exempt. Now, what will happen regarding the anonymous donation, students? Yes. Mansha, 5% of 32 lakh, very good, or 1 lakh, whichever is more. So 1 lakh 60,000 excess will be considered to be taxable. You're correct, Mansha. So 5% of rupees 32 lakh and not rupees 24 lakh or 29 lakh, or it should be 32 lakh only. It should not be 29 or 24 lakh. Understand this point very carefully. So the 5% of that will be considered as the normal, and the excess which is there is going to be taxed under under section 115 at the special rate, which is 3.4 lakh. Are we clear? So just write down over here. Anonymous donation, 5% of rupees 32 lakh or rupees 1 lakh, whichever is higher. So here, remember this should be 32 lakh and not 29 lakh. This should not be 29 lakh. So do not make a mistake of reducing the corpus donation from this 32 lakh. You have to consider the total donations. Okay, you have to consider the total donations for the purposes of calculating the anonymous donation. Yes, Shankara, that is correct. Namrata, yes, correct. So basically here we need not consider the donation which is the only donation excluding the corpus donation. No, that's not a correct way to do it. Here you need to consider for the anonymous donation the total donations. And total donation will include all the kind of donations which are there. Are we getting that? So then the excess which is going to be there is going to be taxed under 115 BBC at the rate of 30%. So you consider the total donation. What is the anonymous donation received during the year? The anonymous donation received during the year is how much? 5 lakh rupees. And the exemption which is there, which is 5% or rupees 1 lakh, whichever is higher. So the excess amount will be taxed at the 30% rate. And the balance will be subjected to tax at the normal rates. Now, it is possible to take a view that the balance donation which is there, which is 5% of total donation or rupees 1 lakh, would be eligible for the application of income. And therefore, you can take the benefit of exemption under section 11. Okay. So you can write it over here. This will come to 32 into 5%, 1.6 lakh. So you can write it is possible to take view. So it is not that this is exempt. It is that this particular 1.6 lakh will be taxed at normal rate and not under 115 BBC. This is not exempt. Remember student, 1.6 lakh is not exempt. 1.6 lakh will not go under 115 BBC. So you can just write it is possible to take view that this amount shall be taxed at normal rates and shall be eligible for application of income as per section 11. Okay. And the balance amount, you can write it over the end, which is the anonymous donation taxable under section 115 BBC. So how much is the anonymous donation which is received? This is 5 lakh minus 1.6 lakh. So do not forget to add this amount because this is going to be taxed at 30%. Okay. Now the next one is hospital operational expenses incurred 105 lakh. This does not include capital expenditure and depreciation. So what will happen in this case, student? Hospital operational expenses. Yes. Yes, Mansha, this will be considered as the application of income. Now the question arises whether you will consider this as application of income prior to calculating 15% or after calculating 15%. So whether this will be eligible for the whether this will be eligible for the application prior to 15% or post 15%, students. Yes. Yes, students. So whether these operational expenses are eligible for application prior to calculating 15% or after calculating 15%. No, Mansha, that is not correct. It is not applicable prior. This is considered as application of income after calculating the ad hoc exemption of 15%. So first you will calculate the ad hoc exemption of 15% and then you will calculate the operational expenses. Are we clear? So you will not calculate the operational expenses prior, but you will calculate the you will allow the application later after you have calculated the ad hoc exemption of 15%. Now, there is a possibility in the examination, you may also get certain adjustments with regard to that. Let's say, for example, out of this, there is one expenditure on which TDS is not deducted by the hospital. Let's say the fees is paid to the doctor in this operational expenses. Let's say 1 lakh rupees is the fees which is paid to a doctor. Now, in that 1 lakh rupees, the TDS is not deducted. So then that will not be considered as the application of income. Remember, I told you this point that for the expenditure to be considered as application of income, you should have deducted the TDS. So that particular provision is applicable. So 30% of the expenditure will not be considered as application. It will be considered as application in the year in which TDS is deducted and paid. It is quite possible that they may have given you one adjustment that, let's say, for example, in this operational expenses, let's say 30,000 is paid to the, let's say, some repair for the repair work in the hospital in cash. So again, that will not be considered as the application of income. Third adjustment could be that, let's say, for example, out of this operational expenses, 2 lakh rupees is incurred but has not been paid during the previous year. So again, that will not be considered as application of income. So I'm giving you the adjustments to be written over here. So you can write down these certain adjustments additionally. Leave some space and then write down less operational expenses. Now, how much is my operational expense? 105 lakhs. Okay. Now, out of this, you can write the adjustment over here itself. Let's say let's write over here. The expenses include the fees to doctor of rupees 10 lakhs on which TDS is not deducted. On which TDS is not deducted during the previous year. Further, an expense of rupees 30,000 incurred in cash incurred in cash for repair of hospital. Also, an expenditure of rupees 5 lakhs has been incurred but not paid. You can write it over here. Has been incurred but not paid during the previous year. Okay. So what I will do is, let's say this is 105 lakh. Out of this, I will reduce the fees paid to doctor on which TDS is not deducted. So 10 lakh into 30%. This will be disallowed, which comes to 3 lakh. Okay. Less expense in cash 30,000. Less expense incurred but not paid during the previous year. So if you remember, only the expenses paid during the year are allowed, irrespective of the method of accounting followed by you, right? So out of this, I will deduct 3 lakh minus 2 lakh and minus 30,000. So this will give me 99.7 lakh will be considered as application of income. Okay. Next is income from medical college solely for educational purpose, rupees 10 lakh. Gross receipts of the college for the year is rupees 100 lakhs. Now what you will do in this case? Income from medical college. Yes, students. What will happen in this particular case? Whether this income you will consider, you will not consider, what you will do? Yes, students, fast. Income from medical college solely for educational purpose, rupees 10 lakh. Yes, faster students, I'm not getting any answer. Yes, faster. No hurry, it is not to be treated as same from incidental business. Yes, yes, Mansha, you are correct. Yes, Munish, yes, yes, Mansha, very good. So let's look at what did we discuss when we started with the charitable trust class. Let's go back to that. 1023C is what we are looking at. So if you look at 1023C students, what did we say? Educational institutions existing solely for educational purposes. If the annual receipts are less than rupees 5 crores. Hospitals which are there, which are not for profit, if the annual receipts are less than 5 crores, the combined receipt from both should be less than rupees 5 crore. Now, in case you look at this particular point, it says the hospital income from medical college, which is solely for educational purpose, the gross receipts of the college for the year is rupees 100 lakhs, which is less than rupees 5 crores. But what about the hospitals whose receipts are more than rupees, the receipts of the hospital is also less than rupees 5 crores. So if you look at the gross receipt from the hospital is 425 lakh, which is 4 crore 25 lakhs, right? Now the receipt from each and every individual, if you look at from the hospital as well as the educational company. So then in that case, it is less than 5 crore. But if you look at the combined receipt, that exceeds rupees 5 crores. So now whether you will consider the income from medical college or not. Yes, whether we will consider it exempt or not. What do you think? Income from medical college, whether this is exempt or this is not exempt. So individually, the hospitals have the less than 5 crore gross receipts. But the hospitals are not solely for the, here it is not mentioned in the question that whether the hospital is solely for the not for profit. But of course, it has received the registration under 12AB. So we understand that. But yes, what will you do in this situation? Yes, faster. Income from medical college solely for educational purpose, whether we will consider this or we will not consider this. Yes, faster. Exempt Salish. Why exempt? Give me one reason why it should be exempt and why it should not be included. Yes, faster. Yes, students not getting any answers. So if you look at it, it says the hospitals which are not for profit if their annual receipts is less than 5 crore. Educational institutions which are existing solely for educational purposes, again if the annual receipts is less than 5 crore. But the combined receipts also should be less than 5 crores. Only then it will be unconditionally exempt. But here the combined receipts are exceeding more than rupees 5 crore. So in this particular case, we will not give any exemption to that. So just write it down. Income from educational institution 10 lakh as combined receipts from hospital plus educational institution greater than rupees 5 crores. So this will not be considered as exempt students. Are we getting this point? I would have considered this exempt if the receipts from the hospital also would have been less. But here my receipts of hospital are also more. So how can I take this as exempt directly? Are we getting this particular point, students? Okay. Next is gross receipt given in one above includes a sum of rupees 55 lakh which has been accrued but not received. Further, a sum of rupees 18 lakh was received only on 31st March 2020. So this should not be 2020, this should be 2024. So just you can change that. Yes, so what will you do? What will you do in that situation? Yes, Mansha, you are correct. It's okay, Sailesh, you can make the mistakes now so that you don't make it in the exam. That's the whole point. What will we do in this case? So yes, gross receipt given in one above includes the sum of rupees, this particular amount. So what we have to do, students, faster. What will happen in this situation? Yes, students, fast. So this will be considered as the deemed application. This shall be considered as the deemed application provided here you have to assume that yes, Mansha, you are correct. Yes, Hari, correct. So this will be considered, Hari, as the deemed application. Yes, Mansha. Yes, you have to file form 10. Also, there is one more additional condition. Yes, there is one more additional condition. What is that additional condition which is there? So if you look at it, I told you for the deemed application of income, see, see, for the deemed application, accrual system of accounting is followed where the income is accrued but not received and where the income received late during the year. This will be application for the deemed application for this year, and the condition is that the income should be applied in the previous year, which is actually in which it is actually received, or next following previous year. But here, what you have to do is here the option is to be exercised of the deemed application by filing Form 10, and the time limit is 2 months prior to the due date of return of income. Plus, additionally, the return of income to be filed under section 139(1). So before the due date of 139(1), the return of income has to be filed. So along with Form 10, you will file the return of income. So here you can consider here like this, less deemed application. So income accrued but not received, and income received late. So both 55 and 18. Option to be exercised by filing Form 10 before the 2 months from due date of ROI plus ROI under section 139(1). Okay. Yes or no? Fine. Okay. Next is the trust set apart rupees 80 lakh for acquiring a building to expand its hospital. But the amount was paid in December 2023 when the sale deed was registered in its name. Yes. So what will you do in this particular situation? Amount set apart for acquisition of the building. Whether this will be allowed. Yes. Manish, Hari, you are saying it's accumulation of income. Yes, Mansha. Yes, capital expenditure is allowed, Manish. There's no problem here. Manish, capital expenditure is allowed. Yes, Mansha. Jigger, yes. Okay, so all the answers I'm getting both the answer. One group is saying that it's not allowed. It's just an accumulation. It's allowed only when it is actually paid. And the second group saying is that it's an accumulation of income. You can allow it. So now what is the answer? Both the answers are correct, students. So amount which is set apart, which is accumulated for a specific purpose, is considered as deemed application. It is considered as deemed application, student. Here it should be December 24 and not 23. The years are actually of the prior year it is given, but it should be 24. You can change that. So one answer is that if you're filing Form 10 and you are accumulating for a specific purpose, you can consider it as deemed application. Second answer is that if you're not filing Form 10, then of course you're right that you will get the expenditure only on payment basis. So the application will be allowed in the year in which you make the payment and not in the year in which you are considering the particular expenditure as accumulated. Are we getting that? So there are both the views which are possible views. Both views are possible. So you can assume in the examination and write for yourself what you feel and proceed accordingly. You have to proceed accordingly in the examination. Are we clear? So just write down over here. You can just write amount accumulated for building. View 1 allowed as deemed application. For this, you have to file Form 10. But if you remember, I told you here that 2 months, it is though it is mentioned that you have to file the Form 10 before 2 months from the due date of filing the return of income. But there's a CBDT circular which gives you the leverage, which says that even if you file the Form 10 by the due date of return of income and not 2 months prior, still it will be considered as deemed application. So if you remember, I had told you for the accumulation, where was it we have written? Yes. So for the accumulation, you have to consider the due date is 2 months prior to the due date of return of income. But if the Form 10 is not submitted on or before the due date of return of income under 139(1), only then the accumulation benefit will not be available. So the CBDT has clarified, the CBDT circular says that you have to file the Form 10 by the due date of return of income. So here you can write down the CBDT circular is giving that. So although the due date is 2 months prior, however, even if it is filed before the due date under 139(1), benefit of accumulation shall be available. Are we clear? So here I can write that by due date of ROI under 139(1). So only in this case, the CBDT has given some relaxation, not in the case where the income is not received or late received. And the view 2 is amount available as application only on payment basis. Now here I am adopting view 1. So I'm considering deemed application for amount set apart for the building. So how much is the amount which is given to me? It is 80 lakhs. Okay. Now in June 2023, the trust purchased and installed a new computer software for 28 lakh. The rate of depreciation is 40% as per the Income Tax Act. Yes. So what will happen in this case? Yes, students. Fully allowed. Yes, Hari, you are correct. Depreciation has to be ignored. Okay, so that's correct, Hari. So just write down over here. Computers, software. This is 28 lakh. Depreciation is not allowed. Fine. Next one is the trust incurred 35 lakh towards the purchase of computer, printer and laptop. So again, this will be allowed. So laptops. So this is going to be 35 lakh. Okay. It repaid the loan of rupees 15 lakh taken earlier for the construction of the hospital building. So repayment of loan. Now here you can, in fact modify this adjustment in line with the amendment that has been made. So if you are repaying the loan, it is allowed, but there are conditions to that. You will write those conditions. That the loan should not be utilized for the corpus donation to another trust. Loan should be applied in India. That if any expenditure is paid for the through the loan, the TDS should be deducted on the expenditure. Expenditure paid through the loan should not be in cash more than 10,000. Application should not be for benefit of any specified person. Repayment of loan should be made within 5 years from the end of the previous year in which the application was made from the loan. So if any application is made from the loan borrowed, that is not considered as the application. But when the repayment is made, so here you can write the adjustment that 40 lakhs was taken as the loan, out of which 30 lakh is applied for charitable purposes and balance has been repaid. So you can write like this over here. I'm writing for your reference. Rupees 30 lakhs has been taken as loan, out of which rupees 15 lakhs has been repaid and balance has been applied during the year for charitable purpose. So in this case, the 15 lakh will not be allowed, which is made as the application. The balance 15 lakh, which is repaid, that will be allowed during the year. Again, that is conditional. You would write those conditions in the examination. Are we clear? So you can just write down. Loan repayment 15 lakh. Application of loan is not allowed. Fine. Then the last adjustment, donation of rupees 2 lakh towards the corpus to a trust registered under 1023C and another donation of rupees 1 lakh paid by bearer check. Yes. So what will happen in this case? Yes, students, what will happen in this particular case? Yes, students, what will happen in this particular case? Donation by bearer check disallowed. Yes, donation towards corpus is also not allowed. Yes, Mansha, you are correct. Yes, Munish, you are correct. So here, both of this will not be considered as the eligible application. So you can just write down over here. Donation towards corpus and donation by bearer check are not allowed as application. Okay. Now here, one thing you have forgotten, this is going to be my receipts, total receipts, out of which you will give the ad hoc exemption of 15%. So which is going to come as 392 lakh plus 2 lakh plus 24 lakh plus 1.6 and plus 10. 429.6 lakh into 15%, 64.4. Okay. So you will reduce rest of the application also. And you will add the anonymous donation. So this gives you 37.86 lakh. Here you will write one note also for the ad hoc exemption. It is, you can write like that. View is taken that ad hoc exemption of 15% shall be applied on gross receipts and not on income after considering operational expenses. Okay. So this is the view I am adopting. I could have taken the Mansha, what you have said, that income from hospital would have been considered after considering the expenses, operational expenses of the hospital. We could have gone like that also. But the ICAI's viewpoint is that we will consider the 15% on the gross receipts and not on the receipts minus expenditure. So expenditure will be allowed as application later and not prior to the 15%. Are we clear? So this is a view that they have adopted relying on the Supreme Court ruling. So this view has been adopted relying on the Supreme Court ruling, and based on this view, they are taking a position that 15% has to be considered as applied from the gross receipts. Okay. So you can just write down this particular note in your examination if the question turns up on this particular point. Clear? Yes or no? Any questions? Any doubt? Yes, you can write the name of the Supreme Court ruling as well, which is Program for Community Organization. Program for Community Organization, Supreme Court. Fine, students. Is this question clear? Yes or no? Any question? Yes, excess 3.4 lakh will be taxed at 30%, Mansha. Jigar, see, this particular question had come in my examination, I think for 10 marks. I think 8 to 10 marks. Yeah. This was my attempt question. Okay. So hopefully this particular question helped you revising the entire topic in detail. Yes or no? Yes. Shall we proceed further then, students? Okay. So now we are moving towards the next topic in this particular segment only, which is the disallowances which are there under section 13. So section 13 will disregard certain amount, will deny the exemption. So denial of exemption under section 13 you can write down when the exemption can be denied. Denial of exemption under section 13. Now section 13 which is there, we have seen for section 11 with section 12, and then now we have section 13. Section 11 is allowing you the exemption. Section 12 is also providing for the exemptions under this particular topic itself, right? So you are now required to understand the 13. So we have the exemption available under 1023C and then under section 11 and 12, right? So section 11 will provide for the exclusion of the income which is held under the trust. So income derived from property held under the trust which is for the charitable or religious purposes, and income from the voluntary contribution which are part of the corpus of the trust. So these are exempt under 11. Then section 12 is basically in relation to the income derived by the trust from the voluntary contribution other than the corpus donation, which will be deemed to be the total income. Are we clear? Then you have section 13, which enumerates the circumstances under which the exemption under section 11 and 12 will be denied to you. So we are discussing at the moment for that particular section. Are we clear? So what are the scenarios in which the section 13 will deny you the exemption? So that's what we have to understand. Now, under section 13, first of all, the exemption will be denied in cases where, let's say for example, you are making the payments or you are applying the income which is there, which is not for the charitable or religious purposes. Are we getting that? So as I said, that you will have the exemption only when you will apply it for the charitable or religious purpose. So if the income from the property which is held under the trust for private religious purpose or for the benefit of any particular religious community or caste, then in that particular case, the exemption will be denied to you. Are we getting that? So you can just write it over here. Income held, the first situation in which the denial will happen, the income held under trust for private religious purpose or established for benefit of any particular religious community. Okay. So if, let's say for example, if the trust is established for any private purpose or for any particular community, except if it is for the benefit of scheduled caste, scheduled tribe, then it is not considered as it is for the benefit of a particular religious community. But this is only for the if it is for only one particular community, that particular trust is established, then the exemption in that case will be denied. So you can write except for scheduled caste, scheduled tribes. Okay. So basically the purpose here is that the trust should not be to promote one particular religion. So if that is the case, then that exemption will be denied to you. Second situation. If the income of the trust is for the benefit of any person, which is a specified person under section 13. So income of the trust for the benefit of a related person or a specified person, you can write. Income of trust which is for the benefit of any related, or you can write the specified person. Now, who is a specified person on purpose? Okay, now who is a specified person? So section 13, which is there, that talks about the specified person. Section 13, subsection 3 talks about the specified person. Now, who are the specified person? Who are the prohibited person? So 13.3 gives the list of the person. So it could be the author of the trust. So just write down specified person is the author of the trust or the settler of the trust, as you may call it. Okay. The person where the author is the HUF. So any member of the HUF. Member of HUF if the HUF is author. Okay. Then any trustee or the manager of the trust. So the trustee is a related person. Then any relative of the author, founder, trustee or manager. Any relative of these person. Okay. Where any person who has made a substantial contribution to the trust. Substantial contribution means where the total contribution exceeds rupees 50,000. Any contributor who has made the contribution more than rupees 50,000 during the year. And any concern in which these people have a substantial interest. Now, what do we mean by substantial interest? Substantial interest, same as you had learned under 222E, deemed in dividend, where the loan or advance is given to a concern in which the shareholder has a substantial interest. What was substantial interest there? That if you have 20% or more of the voting power, or you are entitled to 20% or more of the profit of the concern. So in that particular case, if it's a company, 20% or more of the voting power. If it's another concern, it is 20% of the profit. So to any concern in which above person have substantial interest, which is greater than 20% of voting power or the profit. 20% of the voting power or the profit. Okay. Fine, students. So in case the income of the trust is given for the benefit of any specified person, these are the category of the specified person, then in that particular case, the trust will not be entitled to the exemption. Now, where the income is applied either directly or indirectly for the benefit of the any person, then such part of the income will not be eligible for the exemption. And the said income will be taxed at the rate of 30% under section 115 BBI. Secondly, There will also be a penalty leviable under section 271AA. Are we clear? So these are the two consequences on the trust. Also on the person who is receiving the benefit. If he is receiving any asset, right, either movable, immovable property or cash, then in that case, in his hands, there will also be 56 to 10. Ideally, if you are receiving anything from a trust, which is registered under section 12AB, then in that case, 56 to 10 will not be applicable. Are we clear? So if you remember, we had done 56 to 10 under income from other sources, isn't it? There, if you remember, we had the exclusions under 56 to 10. So if you remember, we had done here the exclusions which were given. From the trust institutions registered under 12A, 12AB, 12AA, 1023C, if you receive any asset, then 56 to 10 is not applicable. Except when I've written the exception also over there. When the amount is received by the author, contributor, trustee, or substantial contributor who is contributing more than 50,000, in that case, 56 to 10 is applicable. I'm connecting the same point again over here. Isn't it? So here you have to write down there will be two implications. One in the hands of the trust. So in the hands of the trust, there will be three implications. This is in the hands of specified person. In the hands of trust, there will be three implications. One is denial of exemption under section 11. So the income applied for benefit of specified person will not be eligible for exemption under section 11. So the income which is applied for the benefit of specified person will not be eligible for exemption. So in that particular case, you will not get the exemption under section 11. Okay. Secondly, tax under section 115 BBI at the rate of 30%. This income will be taxable under section 115 BBI at the rate of 30%. Third, there will be penalty under section 271 AAE. Now, what is the penalty? So, the penalty which is there under 271 AAE is 100% of the amount applied. This is in the case of first time, and in case of subsequent offense, 200% of amount applied for subsequent offense. And in the case of specified person, 56 to 10 is applicable. In the case of the specified person, 56 to 10 will become applicable. Are we getting this particular point? Now here, understand one thing, that this particular, first of all, there will be denial of exemption under section 11. But that does not mean that the trust will lose out the entire registration itself, or will lose out the entire exemption under 11. That's not the case. So you can write, this does not result in losing out of entire exemption. So your entire exemption under 11 will not be revoked. Only that portion will be not eligible for section 11 exemption, the one which is the income which is applied for the benefit of specified person. Only the part of the income will not be eligible for exemption. Secondly, your income will be taxed at the 30% on gross basis without deduction of any expense. And then you will also have penalty under 271 AAE. Yes or no, students? Is this clear? Religious community, Mancha means any kind of particular community which is there for following some religion which is there. So if the trust is incorporated only for one particular religion, any religion which is there, then that will not be eligible for section 11 exemption. Mansha, when we do not comply the conditions, we will be denied to get an exemption. Means unconditional exemptions will not be impacted by this provision. Yes. So any unconditional exemptions which are given to you, that is under 1023C Mansha. So that is something which will not be hampered because there are no conditions to it. It's an unconditional exemption. Okay. Then what are the other reasons for which the exemption under section 11 can be denied? Where the funds are deposited in impermissible modes. So if you are required to invest your corpus into mode specified in section 11.5, or you are required to accumulate the amount in modes required under section 11.5, so then if you are not depositing the funds, if you are depositing the funds in the impermissible mode, then the exemption will be denied. So deposit of funds other than mode under section 11.5. So in that particular case, the exemption will be denied to you under section 11. Okay. Now basically, this is not applicable in the cases where the funds which are representing the profit and gains of business. So the restriction of depositing the funds in the mode specified in the 11.5 is not applicable in a case where the funds represent the profit and gains of the business. Unless, however, where a trust has the charitable income in addition to the profits. In that case, the condition will be there when the trust is required to keep the separate accounts for the business and the income is incidental to the main object. But if the trust has only the business profits, then in that case, this condition will not be applicable. Are we clear? So just write down over here. On income from the property held under the trust, if incidental to the business income to the extent of such deposits will not be eligible for exemption. So just write down. This is not applicable to funds representing profits and gains of business. Okay. If charitable income plus incidental business income, if there is a charitable income plus the incidental business income, then in that particular case, the income to the extent of such deposits then this is then yeah, you can just write restriction of depositing in modes in section 11(5) is applicable. Okay, fine. Then the next one is when else the exemption will be denied. So where the application is made for the benefit of any specified person. Right. So there are certain instances in which the income is deemed to have been applied for the benefit of specified person. What are the instances? You can just write it below this. Income deemed to be applied for specified person. The income is deemed to be applied for the benefit of specified person where loan is given without any security or without adequate interest. Where the income is lent, where the part of the income or the property is lent to any other person without any security. So loan without security or interest. Secondly, allowing the use of the property without adequate rent. So use of property without adequate rent. Then excess payment for services. Excess payment for the services. Inadequate remuneration for the services rendered. Remuneration received for services rendered. Excess payment for purchase of property. Okay. Then inadequate consideration for the property sold. Next is diversion of income exceeding rupees 1,000. So if let's say for example the income is diverted in favor of any another person which is of more than rupees 1,000, investment in substantial interest concern. So where let's say for example the trust is investing in any concern in which the person has the substantial interest. Are we clear? But this is only applicable where the investment is more than 5% of the capital of the concern. Investment should be more than 5% of the capital of the concern. Okay, so in relation to the income which will be denied under 11 or 12 will be in relation to the income arising out of the said investment. Okay, fine. Even if it is less than 5%, the income from the investment which is getting generated, that will not have any exemption under 11. However, the income which is applied for the investment purpose, that will not be denied. So you can write if investment less than 5%, exemption denied for income from investment and not on entire income. Okay, if it is more than 5%, then of course you will not get exemption for the income which is applied. Clear? Yes or no, students? Okay. Any doubt? Further, there is an exception over here. What is the exception? The exception is that exemption will not be denied if the educational or medical facilities are provided to the specified person. So if the charitable or religious trust is running an educational institution or medical institution or a hospital, and let's say there's a specified person who is coming for treatment or for education, then in that particular case, if the services are not provided free of cost or at concessional rate, then in that case, the exemption will not be denied. So that's an exception. If educational institution or the hospital is providing educational or medical facilities not free of cost or at concessional rate, exemption will not be denied. Okay, exemption will not be denied. Are we clear? Then what are the other conditions or what are the other situations in which the exemption will get denied? Anonymous donation. So as I said, for the anonymous donation, these will not be eligible for exemption, which are excess of 5% of the total donation or rupees 1 lakh. But we have assumed, we have taken a view. If you see in the question that also we have solved over here, we have taken the view that the balance donations which are there, balance anonymous donation will be eligible for application of income as per section 11. So it is not that entire anonymous donations will get outside the purview of section 11. Only the excess anonymous donation will not be considered for section 11. The 5% of total donation or 1 lakh will still be considered for the section 11 exemption. So that is a view we have taken. One can also take the alternate view to say that entire anonymous donation are outside the purview of section 11. Okay. So you can just write down anonymous donation forming part of corpus of trust are not exempt. So see, if you remember, any donations which are towards the corpus of the trust are exempt. But anonymous donation, even if forming part of the corpus of the trust, are not exempt. That is entirely taxable at 30%. Okay. Secondly, you can write here anonymous donation in excess of 5% of total donation or rupees 1 lakh, whichever is higher, will not be eligible for Section 11 exemption. Okay. Then if the trust is having the object as the advancement of any other general public utility, and if its trading receipts exceed 20%, then in that particular case, the trust will be denied the exemption under Section 11, irrespective of whether the approval or cancellation of registration has been done or not. See, that is a second thing. The cancellation of the registration or withdrawal of the approval is a secondary thing. But at this moment, once it crosses the 20% threshold, then it will not lead to the exemption under Section 11. So exemption will not be available under Section 11 if the receipt from the commercial activity will be exceeding 20%. However, this temporary excess in 1 year may not lead to the altering the objects of the trust, which may result to cancellation of the registration or withdrawal of the approval. So it does not automatically lead to the cancellation of the registration. But yes, the exemption will be denied. Okay. So just write down. Trust having object of general public utility having receipts from business greater than 20% of total receipts. The increase, or you can just write the surpassing the %20 cap does not automatically lead to cancellation of registration or withdrawal of approval. However, the exemption shall be denied. Under Section 11 shall be denied. So you will not get the exemption under Section 11, but it does not mean that you will also have the registration getting revoked. That is not going to be the case. Okay. Yes. So let's say, for example, if I have not applied, if I have more than 20%, so registration will not be denied or cancelled, but exemption will not be available for that previous year. It is possible in the next previous year, I will have lesser than 20%. So in another previous year, I will again be eligible for exemption under Section 11 for that previous year. Okay. Then non-submission of the Form 10 or non-furnishing of the return of income. So if you're not furnishing the return of income or you're not furnishing the Form 10, in case of the accumulated income, in case of the income which is getting accumulated, then in that particular case, you will not be given the exemption under Section 11. So benefit of accumulation will not be available if the return is not furnished, then and the Form 10 is also not furnished. Or if you are receiving the income, basically which is deemed application which is not received during the year or received late. So in that case, the Form 10 has to be furnished. Okay. So Form 10 not furnished within due date of ROI under Section 139(1) or ROI not furnished under Section 139(1) for accumulation of the income. In the case of the accumulation of the income. Okay? Yes or no? Any questions? Any doubts? Fine. Yes or no, students? Is it clear? Did you understand section 13? Yes, incidental to main object but not maintaining separate books of accounts are also eligible for denial, Mansha. You're correct. Okay, so let's take a break of 10 minutes and then we get back. Then we are left with three important topics, in fact, in the trust. One is section 115 BBI, exit tax, and the registration of the trust. Okay, so let's take a break of 10 minutes and then we get back. So let's start with the next particular point over here. As I said, there is a specified income which is there under section 115 BBI. So just write down specified income under section 115 BBI. Now, what is this specified income under section 115 BBI? So, first one is income accumulated which is greater than 15%, 15%, which is not allowed, where the accumulation is not allowed, where the accumulation is not allowed under the specific provision of the Act. So let's say, for example, the income is over the 85% of the income that you have to accumulate, right? Now, this particular income that you accumulate is accumulation where it is not allowed. Let's say, for example, you are not filing Form 10. Without filing Form 10, you are accumulating for 5 years or less. Okay. So accumulation is only allowed by filing the Form 10 and the return of income. So if it is not in accordance with the provisions of the Act, then it will be considered as specified income under 115 BBI as per the Act. So you can just write down accumulation is allowed for less than equal to 5 years by filing Form 10 plus the return of income by the due date under section 139(1). So if it is not in accordance with that, then this will be considered as the specified income. Secondly, deemed income on account of violation of the conditions for the accumulation of income. So, deemed income on account of violation of conditions for accumulation of income. So let's say, for example, where you are accumulating the income, but you are applying for other than the charitable or religious purpose, or it ceases to remain invested, or you have paid to any other trust which is registered under 12A or 12AB, or it is not utilized for the purpose for which it is accumulated. So if you remember, we have done all of these cases while we were dealing with the accumulation of income. So basically, if you remember these cases that we had done, see, violation of these conditions. So this is considered as deemed income and this will be taxable under section 115 BBI. This shall be taxable under section 115 BBI. So you can write down the same points over here also. The first point will be applied for other than charitable or religious purposes. applied for other than charitable or religious purposes ceases to remain invested, ceases to remain invested. Third one is paid to any trust registered under 12A or 12AB, paid to any trust registered under section 12AA or 12AB. So any donation from the accumulated amount is not allowed, right? If it is paid to a trust. So ceases to be accumulated, applied for purpose other than charitable or religious, ceases to remain invested or deposited in any of the modes specified in section 11.5 and not utilized for the purpose for which it is accumulated. So next one is one second. Not utilized for purpose for which accumulated. This shall be ceases to remain invested in mode specified under section 11.5 or ceases to remain accumulated. So for these, this will be deemed income in the year of violation, and this shall be deemed to be income in last previous year, up to which income was to be applied. Okay. Then what is the fourth scenario? Deemed income on account of violation of the conditions which are basically in relation to the income not received or income received on the last day of the previous year. So if you remember these particular conditions, so if the income is not received during the current year or income is received late, then it is considered as deemed application, but the condition is that the income should be applied in the previous year in which actually received or the next following year, and in case it is received late, then it is to be applied in the next previous year. If income is not applied, then this will be considered as deemed income, right? And this will be taxable under 115 PPI. So even this is covered under section 115 BBI. This shall be covered under section 115 BBI. One second. Give me a minute. Okay. So this will be considered as deemed income under section 115 BBI. Okay. So just write down over here. Income not received during the previous year. Secondly, income received late. So in both these situations, if the income is not applied, if the income is not applied for the year in which it is received or in the next following year, and in the case where it is received late, then you have the time till the next following year. So if it is not applied, then in that particular case, it will be considered as the deemed income. Okay. So here you can write down to be applied by next, to be applied by previous year in which received or next following previous year. Okay. And in this particular case, this is to be applied by next previous year. So if it is not applied by these years, then it will be considered as deemed income. Okay. So you can just write down. This shall be applied following previous year. And this will be my deemed income of next previous year. Okay. So this shall also be taxable under section 115 BBI. Fine. Then income if it is deposited in modes other than section 11.5. Of receipt you can write here. Okay. Then D1 is income deposited in modes other than section 11.5. So income, if it is deposited in modes other than section 11.5, then in that particular case, again, it will be considered as deemed income. Then income, if applied for benefit of any specified person. So this also we already did it. For benefit of specified person under section 13.3. So this also we have already done it. And income derived from a property held under the charitable trust, which is to promote international welfare in which India is interested to the extent the income is not applied towards the charitable purposes outside India. So, income for charitable purposes outside India. So in these cases, there will be the specified income under section 115 BBI, which will be at the rate of 30% on gross basis. So tax at the rate of 30% on gross basis, that is no deduction or expenditure is allowed. So no deduction or expenditure would be allowed with regard to this provision. Yes or no? Is it clear? Mansha, payment to registered trust is allowed, but if it is from the accumulated income, it is not allowed. Payment for any corpus of the trust, again, that is not allowed. So you can just make a small summary of it. Payment to another trust. So if it is from the accumulated income, this shall be my specified income under section 115 BBI, deemed income. Okay, or you can just write down deemed income under 115 BBI instead of specified income. Corpus, if it is towards the corpus, again it is not allowed. Any other payment to trust registered under section 12AA, AB or 1023C is allowed. Okay. So this is a small summary for you. Okay. Yes. Now the next last topic in relation to the charitable trust, which is in relation to the computation of income before we move to the procedural topic, of course, is the exit tax. So just write down tax on the accreted income. Tax on the accreted income. Or this is also known as the exit tax. Now this is provided under chapter 12EB. Chapter 12EB of the Income Tax Act. Now what is this exit tax all about? Let's understand the background of the exit tax. Why is this exit tax levied at the first place? Okay. Yes, any questions, any doubt? Yes, yeah, of course, the 115 BBI, which is there. Let's say, for example, if you have receipts and if you have not applied for the charitable purposes, then in that particular case, it will be considered as the, sorry, not applied for the charitable purpose, that will not be considered as 115 BBI, only these deemed income which are there will be considered for the 115 BBI purpose. Let's say, for example, I've accumulated for 3 years period and then I've withdrawn it or I'm not utilizing for the purpose for which it is accumulated, that will be considered as the specified income, which will be taxed at the rate of 30%. Okay. Or let's say, for example, if I've accumulated for 3 years and then not applied for charitable purpose or donated to another trust, or it is accumulated but not utilized for specific purpose, then in those situations, it will be considered as the deemed income. Okay. Are we clear? Yes or no? Fine. Okay. So let's proceed towards the exit tax then. Yeah. Now, in respect of the exit tax, which I told you, so this exit tax is given under section 115 TD chapter. This is of course under chapter 12EA, but this is under 115 TD. So you can just write down over here. Sorry. Section 115 TD. Now, in which cases the exit tax is applicable and what is the logic behind having this exit tax? All of you with me, okay? So what happens is, see, the trust are getting the exemption under section 11 and section 12, okay? Now what happens, the trust over the years will claim this exemption, will make the assets out of this income. And suddenly one fine day, what the trust will do is it may wind up its activity or it may merge with another non-charitable or any other charitable institution, or it may convert itself to a non-charitable organization. So then in that particular case, of course, section 13 will deny you the exemption under section 11 or section 12 in respect of such trust where the income is not applied for the charitable activity. Are we clear? But what about the assets that have been generated over the year out of this exempt income? So those assets can never be brought to tax. What about the corpus which has been always exempt? Which has been always exempt under section 11. Now that has been lying with a charitable trust and now it itself converts into a non-charitable trust so that corpus remains untaxed forever. So it is always possible for the charitable institutions to transfer assets or the corpus to a non-charitable institution in order to tackle this kind of tax avoidance or this gap which was lying where the assets or the corpus could go to a non-charitable institution tax-free. The exit tax has been imposed on the organization, on the charitable institution which are converting itself into a non-charitable institution. So what are the situations in which the exit tax will be leviable? So just write down. So the exit tax will be leviable in circumstances it is applicable in a situation where the conversion of the trust take place. Conversion of the trust into form not eligible for registration under AA or 12AB or 1023C. Are we clear? So when the conversion of the trust takes place into a non-charitable trust, now there are the situations which are given by which it will be deemed conversion into a non-charitable institution. So what are the scenarios for the deemed conversion? Number one, where the registration has been cancelled. A trust shall be deemed to have been converted into a non-charitable institution if the registration has been cancelled. So cancellation of registration either under 1023C or 12AA or 12AB. Now, what are the situations in which the registration of the trust can get cancelled? So, the cancellation of the registration can happen by the assessing officer or the principal commissioner of income tax, not the assessing officer, but the principal commissioner of income tax. Now, what are the situation in which the trust registration can get cancelled? So the PCIT or the Commissioner of Income Tax only has the power to grant the registration and also to cancel the registration of the trust, where it is observed that there are certain violations which have occurred in the trust. What are the violations? Where the income of the trust has not been applied for the objects of the trust, where the trust has the profit and gains which is not incidental to the attainment of the objectives, or where the profits are incidental to the attainment of objective but the separate books of accounts are not maintained, where the trust has not applied or trust has applied the income for the private religious purposes or for any particular community, for which even there is a denial under section 30, where the activity carried out by trust is not genuine, or where the application was made which had the false or incorrect information. So then in that particular case, the PCIT can cancel the registration. After calling for the documents or information, he may pass an order in writing cancelling the registration or approval of the trust. Are we clear? So you can just write down simultaneously for the cancellation of the registration. So when the cancellation of the registration of trust is going to take place, then in that particular case, there will be the exit tax which will be there. There will be the exit tax will be there. So PCIT or CIT on occurrence of specified violation or on reference from AO on the reference from AO may cancel the registration. What are the specified violations? Where the income is applied, for other than the objects of the trust. Second, the profit and gains, profits from business are not incidental to the objects of trust or separate books of accounts are not maintained, then trust has applied the income for religious, for private religious purpose or for any particular community. Okay. Then activity of the trust are not genuine, non-genuine activities. Then false or incorrect information in the application for approval. So in this case, the PCIT may cancel the registration. Okay, the PCIT can cancel the registration. What is the time limit? It is 6 months. The time limit is 6 months from end of the quarter in which notice was issued. Okay, notice was issued. Fine. So if there's a cancellation of the registration, then in that particular case, there will be exit tax because it will be deemed that the trust has converted itself to a non-charitable institution. Are we clear? So there will be the exit tax leviable at that particular point of time. The second situation in which the exit tax will be applicable is, or when there is a deemed conversion which will take place, will be in a situation where the trust has adopted or undertaken the modification of the objects which do not conform to the conditions of the registration, and it has not applied for a fresh registration. Or if it has applied for the fresh registration, but the application has been rejected. So, it has undertaken the modification of objects of trust and not applied for fresh registration, or registration is rejected. Fine. Third scenario, it has failed to make an application for reapproval or re-registration, where the period of registration is due to expire. Okay, so basically, this is the amendment. Failure to make reapproval or re-registration or renew the registration where registration is due to expire, or the third situation, final registration, failure to make an application for final registration. where the provisional registration has been given. So in this situation, it will be assumed that there is a deemed conversion of the trust into a non-charitable institution, where the registration is cancelled or where the modification has been taken up in the objects and the fresh registration is not obtained, or there is a failure to make a re-registration or obtaining the renewal of the registration where the registration is set to expire, or obtaining the final registration where provisional registration is about to expire. You can write provisional registration is due to expire. Okay. So in this situation, there will be the deemed conversion. Secondly, the merger with an entity. Merger with an entity not having the similar objects and registered under 12AB. Not having similar objects and registered under section 12AA or AB or 1023C. And the third one is non-distribution of assets on dissolution non-distribution of assets on the dissolution to any charitable institution registered under 12AB or 1023C to any trust registered under section 12AB AA or 1023C within 12 months from the end of the month of dissolution. So in these cases, the exit tax will be applicable. So either when you are converting where the registration is cancelled, where the modification of the objects is taking place, or where there is no fresh registration obtained, and thirdly, in a situation where the renewal of the registration is not made, then in that particular case, you will have the tax, the exit tax. Secondly, in a situation where you are getting merged with an entity which is not having a similar objects as yours, or it's registered under 1023, 1023C or 12A or AB. And thirdly, if you're winding up and you're not distributing the assets to any other charitable institution registered under 1023C or 12AB within 12 months from the date of dissolution. Okay. So first one is conversion of the charitable trust into non-charitable. Second is merger. Third is the winding up. Now, what is the specified date on which the exit tax will be applicable? Now, the specified date on which the exit tax will be applicable is going to be, just write down, one second. So you can write here specified date. The specified date which is going to be there. So if the trust is converted into a form which is non-charitable, which is basically a trust is deemed to be converted where it is considered that it is not a charitable institution. Then in the first scenario where the registration has been cancelled, so the date of the order cancelling the registration. So date of cancellation order. So from that date, that will be considered as the specified date when the income will be computed. Where the modification of the objects has taken place and where the fresh registration has not been applied. So date of modification of objects. And where there is a failure to make the reapproval or renew the registration or obtain the final approval where the provisional approval is about to expire. So the last date for making the application. In this case, it will be the last date of making application. In the case of the merger, it's the date of merger. And in the case of the dissolution, it shall be the date of dissolution. So to remember, just remember these 3 points when the exit tax is applicable. First is conversion, second is merger, and third you can write down dissolution. Okay. Now, what will be your income which will be chargeable to the exit tax? So my income which shall be chargeable to exit tax is the accreted income. As we understood, this is the accreted income. Now, what is my accreted income? So my accreted income meaning, accreted income, this means the FMV of the total assets as on specified date. So this is going to be the specified date, what we have already written, less total liability minus total liability. So FMV of the total assets minus total liability, that will be considered as my accreted income. And the exit tax which is going to be there. What is the exit tax which is applicable? So the exit tax which is applicable is on the accreted income. On this accreted income, you will have the exit tax liability. Are we getting that? So what is my exit tax liability? It is going to be, just write down, 34.944%, which is the maximum marginal rate. So this is going to be on the MMR. Accreted income into maximum marginal rate. Are we clear? So on this accreted income, you will have the taxability on the maximum marginal rate. So the exit tax is going to be on the maximum marginal rate, which is 34.944%. Okay. Now understand one thing. What is this FMV of the total assets minus the liability? This is given as per the rules. Okay. So there's a rule which provides for the method of valuation, which says for the different assets, it's in a similar way how we had rule 11UA. So basically, for the quoted shares and securities, you have to take the average of the lowest and the highest price of such shares on the recognized stock exchange. And where there is no trading on the recognized stock exchange on that day, then on the immediately preceding date. For the unquoted shares, it is again similar to what you had done in the rule 11UA, which is the A plus B minus L into PV divided by P, which is the book value of all the assets. And minus the book value of all the liabilities and divide into PV, paid up value, or divided by the P, right? Which is the paid up equity share capital. And for other shares, it's the merchant banker value. For immovable property, it is again the open market value. For any business understanding, it is again A plus B minus L. So again, it is in the similar manner. And for any other asset, it is again as per the merchant banker. And the total liabilities will include all the liabilities except the corpus or the reserves which are there on the and the provision for uncertain liability. So in the similar way, you compute for any other assets and liabilities, it's a similar way. You can just write down in short total assets for the shares for the quoted shares, not only shares, quoted shares, average of highest and lowest price on the recognized stock exchange. For the unquoted shares, it is A asset minus liability, A plus B minus L into PV divided by P. You can write same as per rule 11 UA, which you have done even under 56 to 10. Okay. So A is basically your book value of all the assets. B is the book value of jewelry, immovable property, everything else, right? And then for the immovable property is open market values and any other asset. So any other asset or immovable property, it is the open market value. Okay. And for the total liability, it excludes corpus, reserves, provisions. Okay. Provision for tax. Fine. So this is how you calculate the accreted income. Now in the accreted income, what is not included is the income which has been not considered as exempt at the first place. So are you getting that point? So if the income has not been exempted at the first place, why will it come even under the accreted income? So basically, the income where, let's say for example, the income attributable to any asset which have been acquired out of agricultural income. So that has to be ignored. Any accreted income which is attributable to any asset where the approval was not given to the trust. So before obtaining the approval, whatever income was there, so that for that I've never claimed the exemption under 11. So basically that will not be included. So accreted income which is acquired by the trust during the period from the date of its creation and up till the date the approval is effective. So before the approval, whatever income was there, that has to be excluded. Or any asset and liability of the charitable institution which have been transferred to another charitable institution, again that will also have to be excluded. Fine. So only the accreted income which is in relation to the trust getting converted to a non-charitable purpose, only that has to be included. So you can just write over here, exclude assets from agricultural income, assets prior to approval, and under section 12AA or AB or 1023C, assets transferred to charitable institution on dissolution. Yes, students, any question? Fine. Okay. So this is about the exit tax. This is basically on accreted income into MMR. Okay, so if you get any question, you can get one question on this particular point as well, which is very, very important. So how do you calculate? You have to take into consideration the entire asset, the book value of all the assets minus book value of all the liability. But the point is when it is applicable. That is very, very important. So as I said, this is applicable only in situations which have been listed here, where the trust is getting converted into a non-charitable purpose, basically by not obtaining registration or by cancellation of registration or modification of objects where it is not obtaining a new registration, or it is getting merged with a non-charitable entity, or it is basically dissolved, it is having the dissolution, but the assets are not transferred to a charitable institution. So what you have to do is you have to consider in this situation that what is the activity that has been there. So let's say, for example, if it has any particular asset, but it is from the income from the agricultural operation. Let's say, for example, if an asset has been purchased, let's take an example over here. Let's say a trust is there. Let me write an example for you. Example, a charitable institution, is set up, let's say, for wildlife, okay, welfare. Is set up for wildlife welfare. Let's say it is set up on 1st January 2021 and it has not applied for registration by 31st March 23. Sorry, by 31st March 24. Okay, and prior to this, it was basically having the income. Now, it was claiming the exemption also. Now, let's say, for example, it has the corpus of, let's say, rupees 12 lakh. Let's say a loan of rupees 50,000. Okay, and let's say here there is another loan for building, it is 1.5 lakh. And let's say it has the asset for let's say it has asset 1 for 2 lakh. Let's say it has building of rupees 5.5 lakh and another building for 4 lakh. Let's say this loan for building 2 and this is loan for asset 1. Okay. Let's say there is office furniture of rupees 2 lakh and let's say there is cash of rupees 50,000. Okay. Now let's say this building has been purchased when the trust was not registered under 12AB. So this building 2, this is purchased when trust was not registered under section 12A(b). So in that particular case, I will not consider the building because this is not basically the income from which this building has been purchased is not used for the or is not from the exempted income under 11. So I will not consider this particular building. Are we clear? So I will not even consider this loan. Let's say, for example, this asset 1 which is there is from the purchase from the agricultural activities. So again, this is not purchased from the income which has been exempted under section 11. So I will not even consider this. Let's say, for example, office furniture which is there. Let's say this has been donated to another trust. If it was a case of dissolution, then in that particular case, I will not even consider this. So what I'm going to consider here is, I'm going to consider only this and this cash. I'm not even going to consider this loan because this is again from the charitable activity, from the agricultural purpose. So I'm only going to consider this and that's it. And then I'm done. Are we clear? So the exit tax has to be paid within the 14 days. The exit tax has to be paid within the 14 days from the due date. Fine. So you can just write down. Exit tax to be paid. This has to be deposited within the 14-day period. Okay, students, any question? Otherwise, you will have, of course, the interest at the rate of 1% per month. Fine? Yes or no? Any questions? Any doubt? Yes, students. Okay, so just write down here. To be paid within 14 days, else interest at the rate of 1% per month. Okay. So 14 days from the end of the previous year where the trust has failed to apply, or from the date of the merger, or from the, it is 14 days from different dates basically. So in case the trust is basically registration has been cancelled, so 14 days from the date on which the period of appeal expires. In case, so you can just write down over here after the specified date, payment date 14 days from date of appeal expires. In case of the modification of the objects, again the same. End of the previous year. In both these cases, it is end of the 14 days from the end of the previous year. And in this case, it is from the date of 14 days from the date of merger, and here it is 14 days from 12 months or expiry of 12 months. Okay. Okay. Now we will discuss last topic under the charitable trust is the registration of the trust. Just write down registration of the trust. Now again, this has been a compliance based topic, of course, but again here there is an amendment, so it becomes very important to discuss about the registration of the trust. It's not very complicated. It's a very simple topic. But yes, one needs to be considerate of this particular point. Okay. Now, how the registration of the trust functions. We have to understand that particular point. Now, there are two schemes, as I said, the first regime and the second regime. Under the first regime, when you are obtaining the approval for the 1023C, which is the first regime. So, if you see, if you are the educational or hospital institution or the hospital where there is a which is substantially financed by the government, so in that particular case, you don't need to obtain the registration. It's an unconditional under 1023C. Or where the receipts are less than rupees 5 crores for the educational institution or hospital, then also you don't need to obtain any registration. It's unconditional exemption. It's only in the case when you do not fit in any of these trusts, then only you need to obtain the registrations under the 1023C. So if a trust has been already registered prior to 1/4/2021, then it has to apply for a re-registration within 3 months from April 1st, 2021. Now, this has been extended up to 30th November 2023. So you can just write down over here. Registration of trust. So, first is trust already registered trusts which are already registered prior to 1/4/2021. Prior to 1/4/2021. So what is the time limit for application? The time limit for application is 3 months, but this has been extended. So you can just write the extended deadline. It was September 30th, 2023. This was extended by the CBDT circular. Time limit for passing the order is again 3 months from the month in which application is received. From receipt of application. You can write like that. In case the trust does not apply by 30th September, it will be charged the exit tax. Now this will be valid for, so validity will be for 5 years. The validity will be for 5 years and the approval will be granted from the AY from which approval was earlier granted. So approval from period from the first AY. Okay, the approval will be valid from which the approval was earlier granted to it. Now, this is similar under both the provisions, under 1023C or the first regime as well as the second regime. Are we clear? The second category is the renewal of the trust whose period of 5 years is set to expire. So the trust registration is now given only for 5 years. After 5 years, you have to again renew. So renewal of registration on expiry of 5 years. So this is you have to do 6 months prior to the expiry. 6 months prior to the expiry. And within 6 months from the end of the month in which application is received, after satisfying The PCID, after satisfying about the genuineness of the activities and compliance with the other requirements, will make the inquiries into your objects and then will pass the order accepting or cancelling the registration. For the trust which have already been registered prior to 1/4/2021, for them no inquiry because they have been in existence prior to that. If you have the renewal which is going to be done, that time the PCIT will inquire about your objects. So within 6 months from receipt of application after the inquiry in objects and genuineness. Okay, fine. And this will be again given to you for a 5 years period. So the trust registration is valid for the 5 years. And this will be given to you from the year in which you were provisionally approved. So from the AY in which provisional approval was obtained. So the approval will be from the retrospective effect. Okay. Sorry, not the, no, this is not the case of provisional approval. Sorry. So here from the AY following the financial year in which the application is made. AY following the financial year in which application is made. Okay. Next is, so it will be available from the AY following the financial year in which the application is made. So it will be given to you for the particular year itself from when you are renewing. Third is a case for the provisional registration. So earlier what used to happen is, see, when the trust has already commenced its activity, if the trust has already commenced its activity, then in that case, if it has not availed any section 11 or section 1023C exemption, so it need not apply for the provisional approval. Earlier, what used to happen prior to 1/10/2023, prior to Finance Act 2023, you had to first apply for provisional registration and then go for final registration. So provisional registration is given for 3 years. After that, you apply for the final registration. However, now what they have done is, for the trust which have not commenced any activities, they are first required to go for the provisional registration. And for the trust which have already commenced their activity but have not claimed any exemption, they can directly go for the final registration. Are we getting that? So just write it over here. The trust, if it has not commenced activities, if it has not commenced any activity, then you can write below like this as well. Commencing activities without claiming exemption under first or second regime. Under first or second regime, apply directly for final registration. And If it has not commenced activities, then apply for provisional registration. So if it has not commenced any activity, then only it has to apply for the provisional registration. But if it has commenced the activity and has not claimed any exemption under first or second regime, need not apply for provisional registration. It can any time after the commencement of the activity directly apply for the final approval. But before the end of the previous year. Okay. So this can be applied at any time after the commencement of activities. Okay, after the commencement of the activities. And if the PCIT is satisfied, he can grant the approval within 6 months from the end of the month in which application is received. Or he can reject it if he is not satisfied. Now, this approval will be valid again for the period of the 5 years. Are we clear? Yes or no? So if you have applied, if you have commenced the activity, apply directly for final registration. If you have not commenced the activity, apply for the provisional registration. So just write down. Now this will be applicable from the AY immediately following the financial year in which the application is made. So first I will, for the trust which has not commenced the activity, for that I will apply for the provisional registration. So here it will be provisional registration and the application has to be made 1 month prior to the commencement of the previous year. One month prior to the commencement of the previous year for which the approval is sought. And in with how many months the PCIT will give the approval? Within 1 month from the end of the month. So this will be given within 1 month from the receipt of application. Now, provisional application which is there, provisional registration which is given, this will be without any inquiries. So this will be without any inquiries because this is a provisional registration. But the final registration when it is given, that will be after the inquiries. That will be after the inquiry. And this will be valid for a period of 3 years. The provisional registration is valid for the period of 3 years. Are we clear? Yes or no? And this will be given from the period from the AY for which approval is sought. From the AY for which the approval is sought. Are we clear? Yes or no? So from the AY in which the approval is sought, from that particular AY, this particular registration will be valid. Are we clear? Yes or no? So this is again applicable same for both the 1023C as well as the section 11. Clear? This will be without any detailed inquiry. And if the trust has commenced the activities, if it has commenced the activities, then directly apply for final registration at any time. and this shall be given within 6 months from receipt of application. Again, this shall be valid period of 5 years, and this shall be from the AY in which application is made. So again, this shall be available from the AY in which the application is made. Are we clear? Here, this will be subject to detailed inquiry in objects. So provisional registration without any inquiries for 3 years period, and the if the activities have already been commenced, directly final registration but subject to all the inquiries. Now, if the provisional registration is about to expire, if my provisional registration is about to expire, then in that particular case, what do I need to do? So if the provisional registration about to expire, then in that particular case, at least 6 months prior to the expiry of provisional registration, I will have to apply for the final registration. So 6 months prior to the expiry, I should apply for the final registration. So if you look at it, there's 6 months deadline only. You have to apply for the new registration. And again, the final registration will be given within the 6 months period, subject to the detailed inquiry in objects and genuineness. And this shall be again valid for a 5 years period, and this will be given from the AY in which provisional registration was given. So from the year in which the provisional registration was given, from that year itself, you will get the final registration, because that was provisional. Now the final will be with the retrospective effect. Are we clear? Yes or no? Okay. Yes or no? Any questions? Any doubt? And in case there is modification of the objects. So if there is modification of the objects of the trust, then you need to apply within 30 days. Within the 30 days from the modification when you have done, and it will be given from the AY in which application is made. Yes or no, students? Any questions? Any doubt? Are we clear? Yes, Mansha, everybody has to register. There is no scheme of voluntary registration. Everybody has to register, Mansha. Fine. So this particular provision is very, very important, the registration of the trust. Okay. Also understand the trust have to mandatorily file the return of income before the due date of 139(1) to claim the exemption. In cases where they want to claim the exemption, they have to file the return under 139(1) or by 139(4), which is the belated return. Also, they need to maintain the books of accounts for a 10-year period. So again, that is very, very important for them to maintain the books of accounts of all the contributions that they receive. So that is something which is to be maintained for a period of 10 years. So they have to file the mandatory return of income, as well as they need to maintain the books of account. Now, the last important point before we close this particular chapter is the taxation of the political parties. Now, that's the last topic that I have to cover here. Very small topic. You can just write down. Taxation of political parties. Now, how the political parties are taxed? So, the political parties are taxed in the similar manner only. They are basically the entities which are created for the political agendas. So, they do not have any kind of taxation with respect to certain category of income. Their incomes are exempt. So, just that's what we have to just note it out. So, just write down here. For the political party, the exempt income is your income from house property. Second is income from other sources. Third is capital gain and voluntary contribution received. So all of these incomes are exempt under section 13A. But there are certain conditions. It's a conditional exemption. What is that? What are the conditions? So the conditions are: one is maintain the books of accounts. They need to maintain the books of accounts, maintain the record of the voluntary contribution, greater than rupees 20,000. Then audit of the accounts. Then no donation greater than rupees 2,000 in cash, which is also disallowed under 80G also, right? If you remember 80GGA, 80GGB, you get disallowed for the donations. The donations are not allowed in excess of rupees 2,000 in cash. And furnishing the return of income. Okay. So these are the conditions based on which the income of the political party will be exempt. So in case of the political party, the rent is basically not taxable. In the case of the political party, income from house property is not basically taxable. So rent of a property which is let out to let's say, in case of the house property income, that is not considered taxable. Interest on the deposits, not considered taxable. Voluntary contribution, not considered taxable. So all of that is basically exempt in the case of the political party. So what will be taxable is only the cash contributions which are received or any kind of anonymous contributions that are there. So that will become taxable in the case of the political party. Okay. Yes or no? So if they have violated the conditions, so then in that case, they will have the taxability. Are we clear? Next is the electoral trust. In case of, again, electoral trust also, electoral trust are different than the political party. So electoral trust which are there, they are basically created by the CBDT. And these are basically registered for obtaining the contributions for the political party. So they receive the contributions and pay to the political party. Those are the electoral trusts. Again, their income is also exempt. But again, that is something which is the voluntary contributions that they receive are treated as income. But for claiming the exemption under 13B, their voluntary contributions that they receive, which they distribute to the political party, so that would be exempt provided they distribute the 95% of the donations to the political party and they do not keep it with them. So electoral trusts basically receive the contributions and pay it to the political party, and then they have to maintain the books of accounts and all the donations that they are receiving, the records of that, they have to keep it. Only then their income will be exempt. Fine. Income from salary, political party will not get salary. It's a party which is created, Mansha. It will not have salary. Okay. So this is all for today. In the next class, we'll start with the income from digital transactions. So we'll meet directly on 29th. Merry Christmas. And then we'll see on 29th for the next class. So please revise the trust taxation. Thank you so much. We can close the session.